Well, it's certainly been an interesting time for the markets. The last time we spoke with Phil, the major indices were hitting numerous record highs. Since late February, though, very different story. The U.S. market's down significantly. Of course, numerous reasons for all of this. We're going to get into it now and some of the key themes with Phil. Phil, great to have you back on the program.
Hi, thanks for having me, Greg. Appreciate it.
Times have changed, Phil, since we last spoke. What are you making of all this recent market volatility?
Well, it's all about the tariffs, and the worst thing about the tariffs is now it's April 2nd is like Liberation Day for the tariffs, and that makes it worse because it's all a war of words, really, going back and forth. Will they? Won't they? On, off, and we don't worry. I tell my members at Phil Stock World, don't worry about it being rigged, and don't worry about it. People knowing things in advance. Let's just figure out what's going on and try to stay ahead of the game as the tide goes in and out on this stuff. The S&P is off its high, but there's a lot of bargains to be had, and that's what matters to us. So there are great stocks on sale. That was not the situation last time I was on the show in December, and we're very excited to go shopping at this point.
Yeah, when you think about a 10% correction, which is what we got in the S&P 500 before it bounced a little bit, heading into this year, I had a few people tell me it would be healthy, or at least not unhealthy to see a move like that in the market before we, resumed.
Oh, well, yeah, clearly things were overbought, and we started this new portfolio before August, and we weren't into buying anything. Things were too expensive, and now we've got this phenomenal opportunity to pick up stocks that have dropped 15, 20% from the highs, and they're getting back into a buyable range, and this is what we love. We're value investors. So, bring on the chaos.
Okay, let's talk about a bit of that chaos. Obviously, as we said, centered around the tariffs. We feel it pretty acutely here in Canada because the United States is our largest trading partner. If you take a look at what's happening from a Canadian perspective, does it change your outlook?
Well, 65% of your exports go through the U.S., and that's about $2.5 billion a day. And Trump's original threat was to do a 25% tariff on all exports, which could have crushed export sectors like energy, autos, lumber, like Suncor, Magna, Canfor. Now it's a more targeted tariffs, and it's sparing some industries, but nobody's really sure what. There's no plan. There doesn't seem to be any sort of written thing of what's going to happen next. But we are staying on our toes and playing it by ears. The loonie's at 141 now, and the dollar's down 4% since January. So we'll see how that works out, and we'll see how the earnings go, and we'll see what people say about Q1 and their outlooks to Q2.
Now, up until last week, Phil, we had 5 down weeks. Then we had a rally on Friday, continued into the beginning of this week. What's your read on where we're headed? Probably people are just trying to figure where do we go from here?
Yeah, well, last week the S&P was down about 2%, then it came back, and then it closed. And what we have is a chart that shows the weak bounces, strong bounces. We calculate out what a recovery looks like and put it in black and white. And so right now we're at what we would call the strong bounce line, which is a 40% retrace of the drop. So we had a drop, and now we're up 40% from the total drop, but still that's not even halfway back yet. And today's close, we just drifted along that same line on the strong bounces. FedEx had terrible earnings, and that's a very bad sign. So we got to be careful and watch the data. And consumer confidence was awful today. So we're not out of the woods yet. Let's put it that way.
Not out of the woods yet. We have obviously a lot of uncertainty. I think some guests have told me the only thing certain this year will be that uncertainty, and we definitely get a huge dose of it. If we take a look at the U.S. tariffs, Canada on us here in Canada, then retaliatory tariffs from Canada, how should Canadian investors be approaching all this?
Oh, well, I think look, from the Canadian standpoint, if we want to analyze it quickly, how can I analyze this quickly? Let's talk about, there's the auto issue. You've got the bridge traffic on the Windsor-Detroit Bridge. That's where all your auto parts go through. That can impact companies like MAGA and Linmar. There's steel, and you have the steel tariffs. Now, the funny thing about that is Steelco is very highly affected, but Steelco just got bought by Cleveland-Cliffs. So, we're just screwing an American company, but with their Canadian counterpart. There's Algoma Steel also. On energy, you're going to widen the spread between Canadian oil and American oil. That's going to be affecting Cenovus and Suncor. You've got defensive plays that you can get into, like Fortis Utilities. Minerals like lithium, America might do well. Oh, Descartes Systems is a good one because they are an arbitrage play because they're doing the logistics, and the tariff logistics are going to cause a demand for that kind of service for people to figure out how to get around this stuff.
So definitely areas there for investors to do their homework on. Let's talk about sectors. Those are some specific names there. You threw Stelco in there, a few others. What about the sectors that hold potential opportunities in this environment?
The sectors that hold opportunities. I think that the financials are going to actually do well. And again, it's an arbitrage play. Who can actually make hay, make hay while the sun shines? And there'll be survivors like somebody like BRP who's already sourced half their work to Mexico and to Europe. Some banks are going to be doing well because of the Bank of Canada cutting rates. Even REITs like RioCan can do well in this kind of situation. Gold, absolutely gold. I love gold miners, especially. I don't see the point in owning gold. If I buy a gold miner, they make money using the gold to sell, plus they have a huge amount of reserves. So I like them better than actual holding of gold.